Audit planning and field work. Auditor need to know what they need to prepare before accepting a client. For a new client, firstly auditor need to do an investigation to check their background, whether the company still has relation with the previous auditor. Second, the successor should get client's auditor to communicate with the predecessor auditor. If the permission was declined, the successor auditor should decline the offer. For a continuing client, auditor should determine the reasons for not to continue to audit because of any previous conflict such as threats or risk. Auditor must know their scope of their audit work. First is engagement letter. Engagement letter is an agreement by auditor to conduct audit works and services. It should be sent to the client before start the audit. The reason the engagement letter needs to be prepared by auditor is to state responsibility and scope of the audit works. Besides that is to minimize possibility of misunderstanding between auditor and client. Inside the engagement letter, auditor need to state the objective and scope of the audit, responsibility of the auditor and management's responsibilities for financial statement. Next, we will discuss on fraud and error. Firstly, what is error? Error is an unintentional misstatement of the financial statements. Therefore, auditors need to spend a great portion of their time planning and performing audits to detect unintentional errors made by management and employees. Secondly, what is fraud? Fraud is an intentional misstatement of the financial statements. Auditors spend a lot of their time planning and performing audits to detect fraud made by management and employees. However, fraud is more difficult to detect because those who are committing the fraud attempt to conceal the fraud. Next scope of audit work is setting audit objective. It is the most efficient way to conduct audits is to obtain some combination of assurance for each class of transactions and for the ending balances in the related accounts. Audit objectives for each class of transactions including transaction-related audit objectives, balance-related audit objectives and presentation and disclosure-related audit objectives. Management assertions. Management assertions are implied or expressed representations by management about classes of transactions and the related accounts and disclosures in the financial statements. Management assertions lead to the audit objectives. Therefore, auditors must have a thorough understanding of management assertions to perform quality audits. There are two types of audit objectives. Number one is transaction-related audit objectives. There is 6 general transaction-related audit objectives. Firstly is occurrence. The auditor should confirm that all recorded transactions in the company exist. Second is completeness. Auditor need to check whether all existing transactions are recorded by the company or client. Third is accuracy. Auditor also need to check whether all recorded transactions are stated at the correct amounts. Fourth is posting and summarization. All recorded transactions need to be organized properly, included in the master files and are correctly summarized by the clients. Fifth is classification. All the transactions included in the client's journals need to be properly classified by the auditor when auditing the company. Lastly is timing. The auditor need to observe whether the transactions are recorded on the correct dates. Next audit objectives is balance-related audit objectives. It is important for auditor to have knowledge of client's business and industry to prevent misjudgment of opinion by auditor. First aspect to cover is industry and the external environment. Auditor should know the risk associated to all clients in certain industries. Besides that, auditor must take into account in assessing whether to serve or not to serve a particular client. Next aspect to cover is business operations and process. Auditor must strive to understand how the business works. This is because it will make the work easier because of auditor understand the business nature. Auditor also need to identify transactions with related parties is a must to ensure that there is no threats such as familiarity threat. There also the possibility of a client business threats. Audit risk is the situation in order to give an unqualified audit opinion when the financial statement is materially misstated. First, client business threats is inherent risk. This type of risk is related to the characteristics or nature of the business that may cause material misstatements. Next is control risk. This happens because the client's internal control will prevent material to be disclosed or to be checked by the auditor that prevent the auditor to give a true and fair view report. Lastly is detection risk. In this risk, any remaining materials misstatements after assessing inherent and control risk will not be detected by the auditor. Next, we will discuss on preliminary analytical procedures. What is preliminary analytical procedures? Preliminary analytical procedures are performed during the planning phase of the engagement to assist the auditor in determining the nature, extent, and timing of work to be performed. So, what is the purpose of preliminary analytical procedures? Firstly, it will help in guiding the audit planning. Next, it will help in making a comparison based on the large and small amount, either the amount is understated or overstated. So, now we will discuss on materiality. What is materiality? Materiality is information that is material if its omission or misstatement could influence the economic decisions of user taken on the financial statements. There is two types of materiality. Firstly, on the quantitative factor. The quantitative factor is based on the amount and the aim is an attempt to establish some consistency. Secondly, the qualitative factor. The qualitative factor need more evidence to reduce materiality arose out of a conflict of interest or potentially illegal act.